There is a recent proposal by the SEBI that suggests amendments to the rules governing AIF, including the restrictions on borrowing and leveraging by Category 1 and Category 2 of AIF, as well as the requirement for AIF to hold the instrument in a dematerialized form. So, how do you anticipate these proposed changes impacting the operations and investment strategies of Nisus? And please make our viewers and me understand what exactly these regulations are about.
Certainly. So AIF came into being in 2012, and we've been an AIF manager since that period of time. So it's always been now 11 odd years since AIF has been propagated. It started with a very simple idea that a qualified manager, which has the necessary experience, can actually form a pooling vehicle, which could be a trust or a private limited company or an LLP, have enough people who want to invest in a particular strategy, and they can manage that corpus as per the rules of the AIF. Now, category 1, 2, and 3 were decided based on strategy. So, somebody who was a sovereign fund, was a federal fund, was an MSME fund, and had direct tax pass through benefits, and was largely related with public sectors, were required to be in Cat 1. People who are dealing with any other strategy, including debt, equity, or alternatives, whether it's art or real estate or any other form, were required to be in Category 2. They were considered the more risky asset class. Category 3 was largely limited to people dabbling in public securities. So when you're doing listed stocks, when you're doing hedge funds, when you're doing long short strategy, we're doing commodities, where they are largely listed and tradable securities, that was put in Category 3. Now, Category 1, because it was largely led by PSUs, had a certain dispensation in terms of what they could do and what they can't do and what powers they have. And it allowed a lot of people to actually put money into that without major concerns. In Category 2, leverage was not allowed really, and therefore leverage was allowed in Category 1 because it was largely to deal with government-led institutions or MSMEs or PSUs. Category 2, because it was to deal with largely risky assets which were not liquid, which were not tradable, the leverage norms were anyway restricted. You could only borrow very short term to meet the working capital requirements of the fund for a very short period of time, let's say about a month. And that also for a very small percentage of your corpus, which is a drawn down capital, because you needed to pay for a certain fee, let's say to the auditor or to the valuer or to the trustee. And there was a mismatch in timing between you receiving that fee and you paying the fee. So, very short amount of leverage was allowed. In Category 3, leverage was certainly allowed because again it was traded security. So, like you could do loan against shares, you could do loan against funds, you could do loan against any tradable securities. You could allow a larger amount of leverage. So, therefore, Category 3 had the maximum amount of leverage allowed. Now, given the fact that there has been a recognition that AIFs have burgeoned in size since 2012, it started with a very small corpus and has grown at 120% year on year. Today, we are looking at a 7 lakh crore corpus within AIFs compared to mutual fund industry, which is at 37 lakh crores. In a 30-year time frame, in a 10-year time frame, we've come at 7 lakh crores. In the next 10 years, it's likely to actually reach 37 lakh crores. So, because of the extraordinary growth and participation of a very wider audience of investors, both domestically and internationally within the AIF regime, I think it is now dawned upon SEBI that it needs to be far more regulated, far more stringent, and far more secured the way a mutual fund industry has been functioning over time. And therefore, it's no longer just private money and private manager. It's actually now a very large and wider audience of investors, including mid-income investors who are able to commit up to 1 crore of rupees over a period of time to invest in these strategies. That's really why these measures have been taken. Now, when you take leverage and when you have downturn, the problem of leverage obviously is widely known that leverage can destroy equity. And obviously, that's not the intention. The intention is this private money must go into investments and should not get destroyed because of leverage or greed of the manager to generate supernormal returns on the back of cheap credit. So that's something which has now been clearly dissuaded. And of course, there's been very little leverage available practically for AIF funds any which ways because of the fact that it's not tradable assets and it's very hard to monetize these securities in favor of any lender. So, notwithstanding that, I think SEBI has rightfully said that the leverage must be limited, it must be very small, and it must be constrained in the hands of AIF managers. I think that's a very important step. We've never taken leverage, by the way. We always believe this is equity capital. That should never be taken. We're lenders, we're not borrowers. So if you're not borrowers, then we must put our own capital to work and we must make the best return that is possible in a given situation or a given opportunity. By adding leverage to show supernormal returns is adding risk, which is unnecessary in our case, which is the problem we've seen with NBFCs. Then we start looking like NBFC, where 100 rupees of capital is leveraged 5 times. And therefore, now the problem is actually to service that 400 rupees of capital as opposed to protecting that 100 rupees of equity. I think that's very important that as AIFs we don't become that. Second, when it comes to dematerialization, I think that's a very important step and something we've been asking for a very long time. So far, there were no rules in the hands of NSDL, CDSL, and demat agency as to how to demat units. Today, the regulations have been laid down, and it is now possible and imperative that units be dematerialized. Otherwise, how do you know what you actually hold? What is the NAV? You're waiting for a statement. Okay, I'm sending a statement through my RNT agent that this is the money you've invested, these are the units you hold. But where are these units? Where are those certificates? It's finally just a statement. If I lose the letter, where am I going to look for? So it's very important that any investment, any security be held in a demat format, which can be accessible by you, by your successors, your years, your assigns at any point in time, without actually worrying about documentation. So that's a very important step. I'm very happy that that demat is now made mandatory, and everybody will see units in demat format and will therefore know, because that's a natural step to governance. It's a natural step to reporting. Once I start dematerializing, I'll have to start reporting NAV. I'll have to start impairing it. I'll have to start paying tax on NAV. I'll have to start. So the entire alignment of regulations happens once it becomes dematerialized. So long as it's physical, nobody knows. What do I hold? What is the value? What is the taxability? What is the profit? And who is it available to? So all of these questions get very adequately answered on dematerialization. I think it's a very important step. I think the next step would be listing. So far, it's now only about holding something which is untradable in demat,
Yeah.
because it's private. But what if I want to sell it? I want to leverage it. I want to trade it. I want to transfer it. How do I do that? There must be an exchange for it. So the rules for listing were laid long back, but exchange they were not codified in any of the exchanges. So while SEBI may propagate or promulgate that it's possible to list demat units, and I think that's the first step, and it's very important that now that dematerialization is happening, it will now probably lead to the possibility of listing these units on exchanges, like we have REIT units. So now, why shouldn't an AIF unit? Because a REIT is nothing but an AIF. It's an alternate investment fund, except that it has now got a slightly separate regulations as to how that fund needs to be managed and who can invest.
Yeah.
But still an alternate asset class. It's not a mainstream asset. So, like you can list REITs, you should be able to list AIF funds as well, so that anybody who wants to exit can exit. Why is he locked in for 5 years or 6 years? I had the money I invested. Now today I need that liquidity, but somebody else has the money to buy. I should be able to transfer it on the exchange at fair price, and not be subject to the whims of the investment manager or locked in with the investment manager. So I think that's a very important step. And as the next logical step is now listing of these. So demat first, aligning the whole regulations along with demat, and then moving to the listing regime.
So there are a lot of entry of now AI funds companies. Could you make me understand, is there any entry barrier if you're like, if I'm a individual who have a lot of stakeholders fund, can I also start with an AI
You are
company?
absolutely right, and that's one of the pitfalls I mention every time is that the entry barriers today are still very low. The
Okay.
capital contribution required is capped at 5 crore rupees. Okay, so 2.5% capped at 5 crore rupees. That's a very small amount today for anybody to put together and start an AI fund, right? So I think it's very important that the track record of the manager, of course, they ask for credentials, they ask for track record. SEBI, by the way, takes a lot of due diligence and is fairly stringent about who they accord an AIF license to. But still, I think the entry barriers are low because of the capital employed by the manager.
Yeah.
Once the capital employed by the manager, the sponsor is higher, then the entry barriers to set up a mutual fund is very high because of distribution costs, because of the AUM, because of so many other issues. Everybody cannot set up a mutual fund. Everybody cannot set up an insurance company.
Yeah.
But anybody can set up a 20 crore AIF because that's the minimum threshold required to raise. So long as you can raise 20 crores, you can be an AIF manager, where your skin in the game is 2.5%. It's very small. Fortunately, today, I think what's happening is that SEBI's also recognized this fact and they're putting in a lot more measures. So they're asking for where is that money coming from? Is it your own capital? Is it third party capital? Plus, what has been your track record and ensuring that whatever is promised actually happening. So there is no evergreening, there's no stuffing of assets. You're not taking third party assets and stuffing it to third party investors and making money on the spread on the side. It's ensuring that you don't keep on, rolling over AIFs from one fund to the other. The terms are finite. You cannot keep on extending terms. So a lot of the governance measures that now today SEBI is saying is something that we have always promulgated, followed, and always hoped that these would become stops or checks or measures that the regulator would have for everybody. So while it was codified, it was never implemented or discerned upon. Now today, given that people have AIFs running for for 12, 13 years. I mean, almost as long as the regulations have been around, and haven't actually closed that fund, haven't actually returned back the money. While it was supposed to be a 4 year or 5 year fund, it's now running for 10, 11 years. I think that's really what's, sort of kept these regulations sharp, saying now we have enough evidence, we have enough history of 10 years to now see what went right, what went wrong, what needs to happen, so that this now becomes a mainstream investment asset class,
Yeah.
not just an alternate asset class.
Yeah.
Given the size, given that it's likely to reach mutual fund size in India, it must have all the checks and balances like a mutual fund should, and that's really where the endeavors are.
So a thorough check always happen if even you have opened a AI fund, where the money is coming from,
Absolutely,
who are the investors,
absolutely,
where are they are based out of. All those thorough checks
absolutely,
happen.
absolutely.
Okay. So I want to know from you, recently this Central Board of Direct Taxes clarification has come regarding the taxation of non-resident investors' income from offshore investment through an AIF fund in an international financial service center that is in India is Gujarat, Gift City. So does this clarification present any new opportunities or challenges for Nisus Finance for its operations? And what is also your take when it comes to Gift City investment?
I'm super excited about Gift City, Kritika. In fact, I was in Gujarat last week, and I'm there now almost every fortnight or every month. We've set up our office in Gift City. We're now getting a license to be a manager in Gift City as an international investor advisor, and I think it's one of the most daunting, the most expansive, and one of the largest opportunities available in India for
Mm.
investment manager for multiple reasons. The first is that's the only IFSC in the country, the only international financial services center which allows pooling of any capital, global or domestic,
Yeah.
for multiple strategies. B, it's tax free for 10 years. No
Yeah.
income tax, no GST, no taxation, no stamp duty. I can operate out of that region without worrying about taxes. And it's a complete pass through. It's a single stop shop. There's a single regulator within the SEZ and within IFSC who's now, tasked with this whole responsibility of maintaining the regulations and governance. And it's very, very progressive. It's on the lines of what we've seen in the IFC in Dubai, what we've seen with Singapore, with Mass Monetary Authority, where you can actually do investments like you would do sitting out of Singapore or sitting out of Mauritius or sitting out of DIFC in Dubai,
Mm.
which are the one of some, or even Luxembourg, which are some of the largest and most popular investment jurisdictions in the world. So when you have those regulations, we can actually create a very directed investment
Mm.
and does not necessarily have to follow all of AIF regulations. It actually meets investor requirements, which means as an NRI, I'm coming in, I only want to invest into this opportunity. I can come into Gift City, I can invest in that opportunity, I can take my money back tax free. I think that's fantastic. Purely today, the largest opportunity
Mm.
is for Gift City, and this whole question about NRI taxation was a very big question because the rules for NRI investment when they're investing in India or India opportunities is very clear. They fall in a very different tax slab,
Mm.
both in debt as well as in equity. And
Mm.
the taxation levels are very high, whether doing from NRE account or NRO account. And there was always this concern that if I came to Gift City, would I be subject to the same scrutiny, to the same regulations, and to the same taxation? This whole freeing up of tax for the NRI investor means that today the diaspora, which is so keen, wanting to make that investment. There's so much liquidity, there's so much wealth within the Indian diaspora, which is wanting to make that investment, is today actually freed of this burden of wondering, should I come from NRE, come from NRO, who will get taxed? Can I buy this? Can I buy that? Can I invest in an AI fund? No, I can't. So can I buy a demat security? No, I can't. If it's not listed, can I buy unlisted? There's so many constraints for an NRI investor if he's not a tax resident in India, that all of these dissipate when they come to Gift City. Is able to play the entire investment market more freely. Capital can come in freely without any concerns, without any issues, and it can go back freely as well. So I think that's a very large and very important change. We're very excited because we think that what we've done in the last 10 years as AIF managers and the corpus that we managed and built, we can do it in one third the time in Gift City. And that's why we're very excited about where Gift City is and what's happening with it, and the opportunity it is presented to all of us.
So recently we heard this news that Nisus Finance had raised fund from Singapore. Could you tell us about this fundraise? What has happened behind it?
So we've been a domestic fund manager for the last 10 years, Kritika, and AIFs have been an emerging asset class, and foreign investors have directly come through FDI or FPI route. But in today's environment, we have seen that the interest for India as an investment destination has
Mm.
increased exponentially. And not everybody has the ability or the infrastructure to invest directly as an FDI or as an FPI in the country. Which means in any of our travels, and I've been actually selling the India opportunity for the last 20 years as a manager, and it's been hard.
Yeah.
People have looked at Asia, but ex-India sometimes. People have looked at India, but very selectively into public equities and to specific opportunities or technology. But investing into alternatives has been a difficult terrain for most global investors because it hadn't matured or emerged enough for them to completely understand. Today, it's an obvious choice. You don't necessarily have to now come to FDI or FPI. You directly come in as an AIF and you can play the India opportunity like a domestic investor without any concern. Now, that's a very powerful situation for us. Now, that requires that we actually create the pooling vehicle in the geographies that are likely to contribute the most capital. So that's why we have the Singapore vehicle. The Singapore vehicle's objective is to actually pool in the interest of investors, could be the Indian diaspora,
Mm.
who are now residents of Singapore and of the greater South Asian economies, largely coming out of Hong Kong, coming out of Korea, South Korea, coming out of Japan, and even some of those folks out of Europe and US who are now domiciled and resident in Singapore, because Singapore was the foremost jurisdiction in Asia for pooling in global capital because it has the most evolved and governed regime within the Monetary Authority of Singapore, which allowed people to actually come to Singapore and have a very complete, transparent, and tax pass-through investment vehicle in Singapore. So all that capital, which is now resident in Singapore, which may have originated in any part of Asia or originated within the US or Europe, is obviously now in Singapore and looking to find its way into India, as opposed to directly coming into India and then having to work with the double tax avoidance treaty with each of these investors and their KYCs. A lot of investors actually prefer, because they have bank accounts and residencies in Singapore, to actually pool money in Singapore dollars or US dollars in Singapore. So that's really how we got started with the first $100 million of commitments, saying, okay, let's $100 million now co-invest or invest in the AIF. That
Mm.
way, it can actually find the conduit to this opportunity that we're currently pursuing, which generates a significantly high uh, dollar based yield for the investor. So remember, while interest rates have risen globally, but still it's in the single digits, 4%, 5%,
Yeah.
6%, which was earlier maybe 1%, 2% or less. But the inflationary environment in global economies is far greater. So when the interest regimes were 1 2%, the inflation was nearly zero, and so therefore on a real basis people were still able to earn positive yields. Today they don't, because the inflation, for example, in the UK and many parts of Europe is nearly in double digits, which means a single digit dollar return or a euro return is not sufficient. So
Mm.
they will have to come to us. And when they come to us and they see, well, I'm able to generate 15, 16, 17% dollar returns. Now, that's a very attractive proposition in a secure environment, in a highly collateralized and protective environment with the regimes that we have today, regulatory, and the beauty of the currency being fairly stable compared to most of the other global and Asian currencies in terms of volatility. So the rupee has shown one of the least volatilities as compared to the dollar.
Yeah.
And that makes it very attractive because now the hedging costs are lower, your confidence in the rupee is higher, your ability to therefore predict that on a dollar on dollar basis, on a fully hedged basis, I can actually generate high teen returns. Now that is really what drove this whole decision, that people said, well, we like to come in, how do you allow us? I
Mm.
said, then the best way is let's have this vehicle in Singapore. It's a jurisdiction everybody understands, your capital is already there. Let it create a conduit for our special situations fund. And that's how we got started with Singapore.
Lastly, I want to know, as the founder and the MD of Nisus Finance, what are your future plans for the company? What are the future plans with regards to even expansion of the services?
That's a secret, oh? Okay, well, no, I'm very excited to share.
Mm.
What we're trying to do is very simple. Today, the special situations fund that we currently are investing and that we've launched and which is now investing, I think is a very large, expansive idea. Which is why we have the Singapore pooling, we have the Gift City, and we have our domestic AIF, which cumulatively can put almost $500 million to work in the top 1% opportunity in the space. So that's how large the opportunity, that if I just target the top 1%, I can actually put $500 million to work. So that's the first thing that we're trying to go and expand out in a big way. Um, Second is, as I was talking earlier, that the shared environment, we like yields.
Mm.
Today it's a yield environment. Yields are high, interest rates are high, yields are high, and people are looking at stable and continued yields in real estate assets. Now, office space may or may not be able to provide that in a classical format the way I see it. I've done a REIT in the past. But I think the shared economy environment, when you look at co-working,
Mm.
now co-working by itself has shown the largest amount of growth in terms of grade A office space absorption over the last 24 months.
Yeah.
The share has actually shot up to double digits. It was in single digits. And as a strategy, the largest REITs are creating spaces for co-working environments.
Mm.
Now that's a very expansive idea. And the yields are obviously far greater than what you'd have in a classical format because it's a shared environment. So there's more efficiency of space.
Yeah.
There's more efficiency of utilization of a sweating of assets. We're seeing the same thing now in resurgence of co-living assets. When you're looking at student accommodation, we're looking at other shared assets, with people going back to schools, back to work, back to jobs. I think this whole shared economy assets have a very huge potential, especially now that we've learned what is that people want in a black swan event.
Mm.
How do we create that safety norms? How do we create enough bells and whistles to ensure that people have what it takes to live out of shared and work out of shared environment? I think that's a very expansive idea, which is at the fledgling or at the cusp of a huge growth.
Mm.
So that's the other product that, and the other investment opportunity that we're curating, which we're likely to offer. The third is an opportunity where there is enough potential within the top 10 developers to create great products.
Mm.
So, what is a developer? What does a top 10 developer need? He needs a land in the right location
Yeah.
at the right price, which he can build and sell. Now, land may be available in the hands of a landowner uh, who's in distress, and the developer is obviously also looking at a shortage of capital. So,
Mm.
today, the expansion opportunity of consolidation is obviously limited by capital. So, what if we can marry these things? We take a top grade A developer in the city, and we take a stressed asset owner, and we actually marry them and create that capitalization so that effectively, while the grade A developer is not going to be ever willing or able or required to pay a very high rate of return or profits to me, because of this situation where I'm actually creating this marriage, I'm able to actually create a very secured margin on my
Mm.
investment in the hands of a grade A developer. Because I'm creating this alliance, I have the ability to take this asset, solve the capital issue in this,
Mm.
discharge the loan, and say, okay, now here's this asset, please monetize it and give me these returns. So
Mm.
that creates a win-win. So it's about curating these opportunities in a scenario where there's consolidation happening and creating that acceleration of consolidation by
Yeah.
marrying, to the interested parties or related parties. I think that's the idea. That's the third idea, which means that it's a multiples game now.
Mm.
It's no longer a 18, 20, 22% coupon business. It's actually a 35% return business, which means you actually double your money every 2.5 years. So that's the third thing that we're expanding because that's the opportunity. So there's a
Mm.
huge set of people who thought they'll become developers, land bank, and now really don't have the ability to move forward.
Yeah.
And here are developers who are wondering which is the next project which I can do, but I'm not going to buy any more land. So
Mm.
of course they're trying to do their own searches, but by the way, these people have already come to us saying, "Can you rescue me from this loan?" But you don't have the capability to build it, so let's create this marriage, and
Mm.
let's then create that spread for ourselves, so that everybody's in a better situation. So that's really as far as the domestic environment goes. As far as offshore goes, and that's the other thing that we're now launching is a global fund because I think there is an opportunity when we are facing geopolitical shocks and we've seen a softness in asset pricing. Um, I think it's a great time. Again, being counter cyclical and intuitive is going to those economies and buying something at a low price, which is yielding
Mm.
and which can actually generate 10, 11, 12% dollar return. So today, a lot of great assets globally are able to dispose of those assets because the owners are stuck for liquidity,
Yeah.
especially with the geopolitical shocks, with the interest rate rising. They're not able to service those loans because they over leverage those assets. They're able to take a haircut, because when they were a 3% regime and suddenly it goes to an 8% regime, who's going to pay that balance 5%? Somebody has to pay it. Now, that's not something I can pay because I over leveraged,
Mm.
right? I took a remortgage on that asset. So they're taking a haircut. The banks will take a haircut, the owner will take a haircut and get a cheap asset. So today we've been to identify absolutely core prime assets in great countries and economies with a 10-11% net dollar yield. Now, when I can do that, and then obviously that's in the growth where when the cycle comes back and interest rates reverse, I'll end up making 18 to 20% returns without a doubt. So that's the opportunity where under the Give City route and the LRS, and if we can have that diversification in a small way, where we can actually, because we understand real estate, we understand the dynamics, can we use that opportunity to now for India to play global? It was always global playing India.
Yeah.
Now can Indians play global? So that's really where our largest endeavor is in this financial year.